I want to have a real principle-driven conversation about where the market is right now because, let me be honest with you, the situation we're seeing never ends well. And if you're a new investor or you've only seen stocks go up, I'm here to give you the perspective you won't get anywhere else because here's the truth. It's too late to ignore warning signs. And pretending is that things will stay rosy forever, that's how people lose money. So let's walk through this. The goal isn't fear. The goal is preparation. And guess what? We're probably all going to lose money in a market downturn, but it's about being prepared to know what you do when that happens. Because if you understand what's coming and how to handle it, you're going to be light years ahead of the crowd. Everyone wants to be different from the crowd. Yet investing, it's the area everybody wants to be the exact same as the crowd. I want you to be different. Every year since 2022, the statements from our channel have been the stock market has been on a tear. And we could go back almost 10 years and point to the start of this run. It has felt unstoppable. But the reality is there are 3 guarantees in life: death, taxes, cycles. Markets move in cycles. And if you think the music will keep on playing forever, you're not understanding history. You're not paying proper attention. And that's okay. Because out there in the media world, they're not here to teach you. They're here to put FOMO in your eyes so that you do whatever it is they're going to get clicks on. Let me state this as clearly as possible. This kind of euphoria never, and I mean never, ends well. We've seen this before. Dot-com crash, great financial crisis, COVID crash, Great Depression, 1970s stagflation market, 1987 quick crash. They all looked fine until they weren't. And each time, people beforehand either behaved or said the words, "This time is different." It never is. The stock market is a machine that weighs businesses over time. But in the short run, it's a voting machine where people go in and cast their votes by buying stocks and selling stocks. The more popular stocks go up, the less popular ones go down. It's based on hype in the short run. It's based on stories in the short run. It's based on massive emotion in the short run. And right now, the votes are flying in fast, and it's all emotion, and it's pretty much all good news. But let me walk you through what a crash really means. A pullback is when the market falls 5-10% and then recovers quickly. We've seen it probably 8 million times in the last 15 years. A crash, that's much deeper. Since 1950 on averages, stock crashes have dropped around 33% and taken over 2 years to recover. Imagine opening your brokerage account and seeing your investments cut nearly in half. Could you stomach it? Would you know what to do? Now, what I hear from everybody when stocks are going up, yeah, I could stomach that. I'd buy more stock. Things were great. But everything in history shows the opposite. People panic. They sell. They make the exact wrong decision at the wrong time because the story changes during a crash. And they'll say, yeah, I was going to buy, but look at what's going on in the market. This is another version of it's different this time. It's not different this time when stocks are going up. It's not different this time when stocks are going down. I want you to learn that. I want you to ingrain that in your brain. If you understand valuation, if you understand how to measure a business, if you understand how the market reacts emotionally to things, you will stay calm and you will take advantage of it. Guys, nothing gets me more excited than doing this. So let's talk about one of the biggest tools I use when I'm trying to figure out if the market is getting ahead of itself: valuation. It's the one thing people should be paying attention to, and it's the one thing they don't. What we look at is the Warren Buffett indicator, the stock market to GDP ratio. It's very simple, and it makes logical sense. It compares the value of the stock market to the entire size or GDP of the economy. Guys, as the GDP of the economy grows, the companies within it should grow along the way. And vice versa. As the companies within an economy grow, it'll drive up more GDP. It works, it always has worked, and it'll always work because this is what economics does. This is the stock market GDP ratio. We actually have exactly 100 years of data, 400 quarters of data. The average is 6.4% of return over the next 10 years on any quarter. Does not include dividends. If you add dividends in there, even though dividends recently have been low, historically they tended to be 4, 5, 6%. So it takes us to the 10% mark. Right now, we're at a ratio of 2.25. That's 127% overvalued. Not 127% of value, 127% overvalued. It has the fair value of the S&P at 3,003. Now, have I been saying this for a while? Absolutely. Have all the greatest investors of all time been saying this for a while? Absolutely. Has it been wrong? Well, I will say this. The part that's wrong is, as valuations get higher and higher, the market has gotten better and GDP has gotten better, so it's made up for that. But it doesn't change the fact that we're still massively overvalued. That part has not changed and not incorrect. Now, I went and looked further at the data. Okay, let's look at data on all the times that the valuation was 30% or better undervalued. So 30, 40, 50% undervalued. Right here. The average return, not including dividends, 10.7% versus 6.4%. Over 50% higher. Now, guys, as I go along here to overvaluation, look what happens to returns. Is this coincidental? 10.7, 9, 2%, negative 1.1, negative 2, negative 2.4%. Guys, it's not a coincidence. It makes perfect sense. The more you pay for something, the less your future returns. I want to make something really clear that almost nobody on YouTube talks about. Valuation is the structural issue behind every major crash. Yes, the news will point to the spark, debt ceilings, political tension, wars and inflation. But what's the thing that sets the fire? That's valuation. That's the gasoline in the room with a fire in the corner. We don't know which spark is going to cause the explosion, but we know there will be a spark that causes explosion. John Hussman gave that analogy once, and I thought it was absolutely brilliant. Now, guys, I don't ignore the macro stuff. I'm aware of it, but I don't worry about it because I worry about the long term of the economy. Do I think the U.S. economy will be bigger 20, 30, 40 years from now? If the answer is yes, then I buy based on a reasonable valuation. But when valuations are sky high, any spark that happens can set it all off. When stocks are priced for perfection and then the world shows even a little bit of a difference, boom, it's going to be a bad sell-off. Right now, the top 7 stocks, the Magnificent Seven, control way too much of the market. This kind of concentration has only happened in bubbles like in 2000. We've got over 38 trillion in US debt. Rates have been rising for a while, way higher than they were back in 2022, and corporate earnings are starting to slow. Not exactly a recipe for smooth sailing. But again, I care most about structure, not the latest headline. And structurally, high valuations are a warning light flashing bright red. Now, before you think I'm some futster who's against the US and US stock market doing well, you're absolutely wrong. I believe that America is the best place. In fact, I am an immigrant. I was born in the Middle East. We came here. It drives me nuts when people say it's not great. They're absolutely stupid. But a great thing can still be overpriced. I know that even great companies will crash if the price gets far too ahead of reality. You can still be an optimist, but realize you're overpaying. Now, guys, people keep saying, and not just with words, with actions, Paul, this time really is different. It's AI. It's bigger than the internet. Okay. Every single time we have new technology, it's bigger than the previous one. Of course it is. Why? Because it's newer technology. But guess what? The story is still the same. 3 years ago, it was EVs. Before that, it was cryptos. Even now, it's cryptos. Then it was NFTs, cannabis. It was the internet. It was real estate. It was computers. It was radio. It was TV. It was all these things. And guess what? It was tulips back in the 17th century. Every bubble starts with a great premise. Then comes a little bit of excitement, then the hype, then the euphoria. The media gets on board. Your friends are buying. The waitress is buying. Stock prices keep rising. Everyone says you can't lose until suddenly you do. This never ends well for people who buy blindly. The faster the market rises, without the fundamentals behind it, the more brutal the fall. That's not pessimism, guys. That's logic. It makes perfect sense. And if you don't study history, the market will teach you the hard way. Now, I'm not telling you you're going to avoid losses by listening to me. What I'm telling you is you're going to be prepared for them, and you're going to bounce on them when they happen. Warren Buffett says that every bubble starts on a sound premise. Something new, revolutionary, exciting, or even something simple, owning a home. Then attention grows. A little FOMO starts to kick in. Prices start to go up. Media fuels the fire. Prices go up more. Smart money starts to exit quietly. Well, who's the smart money? Well, guys, it's not who you think it is. It's not the investors out there at the big hedge funds or the big mutual funds. It's the value investors. And then the panic hits. We see it in every cycle. EVs, SPACs, memes, NFTs, all the same story. Look at Buffett right now. What's he doing? He's sitting on cash. You can't compete with market euphoria. That's a lesson I learned the hard way. And I'm okay with that. It was a great lesson to learn. But this is exactly why I teach on YouTube. I've learned 30 years of investing, and I wanted to teach people the lessons that I needed to learn. Guys, it's no coincidence that all these value investors think very similarly, and in the long run, they do very well. I remember when everybody's saying that Cathie Wood was way better than Warren Buffett. Fast forward just 2 more years, and Warren Buffett was far ahead of Cathie Wood. So if you ever want to learn how to generate a return above 4 or 5% on the cash sitting in your business and buying great companies at better prices, that's the way you do it. So if you want access to this class, we're going to give it to everybody on the email list first. Click the link in the description below. Make sure you're signed up to get updates in the future. Get first dibs because this option class could be a game changer for your investing. It's something I wish I learned 25 years ago. So how do I know when it'll crash? You don't. You'll never know when it's going to crash. That's the scary part. Bubbles don't pop on a schedule. They pop when there are no more buyers, when expectations get too high, when reality shows up, when that spark from the fire in the corner finally lands on the gasoline, boom. But we don't know what's going to happen. But the biggest warning sign that's going to get closer and closer is when the average person feels like it's so easy, when they get excited and hyped about a stock and they don't even know what the company does. Guys, last year, I was in Naples with some friends. And in that group was a guy worth about $200 or $300 million. And he was talking about NVIDIA and how incredible it was, and the stock was going up like crazy. And I looked at him and said, and he said something like, oh, NVIDIA does like $50 billion in revenue. I go, no, double that. It's about $100 billion. He's like, oh, even better. I was like, do you know what NVIDIA does? He's like, I don't know. It's computer related. And I was like, man, this is a guy worth $200 or $300 million. And I've talked about this many times. This is a guy worth $200 or $300 million. He doesn't even know. He's bragging about this company and doesn't even know. That's why I always laugh when people say that person's rich. They get it. I'm like, no, he made a lot of money from running a business very well, not by being an investor. And guess what? How long has it been? It's been almost 2 years. It's been about a year and 8 months, and the market still hasn't collapsed. Okay. When the waiter, the Uber driver, the kid next door starts giving stock tips, that's your cue to be cautious. So what do you need to do? The solution isn't to run. The solution is to prepare. Just like if you got sick, if you're going to get the flu next week, you don't sit there and stop right now and say, okay, I'm not going to do anything. No, you still live your life and get ready and say, okay, I'm going to drink some more orange juice. I'm going to take some medicine. I'm going to prevent some things. Whatever it is you need to do, you get prepared. You'll probably still get sick, but you won't be as sick. If you understand how to value a business, if you understand the most important thing, price versus value, and how to buy, you will stay calm. You won't buy the hype. You'll buy the fundamentals. Revenue, profit, free cash flow, balance sheets, future projections, all these things. If the price makes sense and you're ready, you invest. If it doesn't, you wait. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. Every crash looks obvious in hindsight. Guys, as Morgan Housel, one of the best financial writers of all time, said so eloquently in his Psychology of Money book, every past crash looks like an opportunity. Every future one looks like a risk. Guys, look at this chart of the S&P going back to 1950. You can see the places where they dipped and you say, I wish I'd bought there, and probably 7, 8, 9 times. And guess what? At every single one of those times, there was fear. There was the world's going to end. When we look at hindsight, we go, damn, I wish I'd bought then. But in the moment, people are like, oh my God, the world's going to end. It didn't. It's never ended. And guess what? If it ends, you might as well be buying your stocks then. The people who make money, they're the ones that buy quality stocks and ETFs as they're dropping. Dollar cost averaging, ignore the noise. I always give this example. If you bought the peak of NASDAQ in January of 2000, in March of 2000, you would have seen it fall 80%. But if you kept dollar cost averaging back in March of 2000, starting at the peak, I want to repeat, starting at the peak before it fell 80+%, if you kept doing it till today, you made over 14.5% annualized return on your money. Even if the NASDAQ falls 50%, you're still 11 or 12% returns. Guys, that's incredible. You cannot predict the market where it's going to go in the short run, but you can control your own strategy and behavior. You can buy low-cost ETFs, month in, month out, dollar cost average, stay consistent. If you want to pick stocks, use our stock analyzer tool. Stick to companies you understand. Learn how to value them. Now listen, this is where I bring it home because when the market gets crazy, whether it's flying high or falling fast, both will happen. This is where investors lose their way. They start reacting to headlines. They chase the hype. They panic when prices drop, but not us. Remember, news follows the stock price. As the stock is falling, the news will be coming out there that justifies that. As the stock is rising, the news will justify that. The best part was example of like Alibaba. When Alibaba was over $300 a share, nobody questioned it. It started to fall to 150 and below, and before you knew it, they had the reasons. What were the reasons? 1, delisting from the New York Stock Exchange, and 2, this idea that you didn't own the company, you owned access to the cash flow because of an ADR. That's always been the case. Every single time a foreign company is listed, that is a risk. But suddenly it was a big risk, and guess what? It never panned out. Guys, we don't panic. Why? Because we invest with principles. I say it all the time. Process over prediction. You don't need to know what the Fed will do. You don't need to time the exact top or bottom of the market. You just need a set of rules. Simple, proven, and more importantly, repeatable, that you follow no matter what. The principles we have are, 1, we are investors, not speculators. 2, every investment is going to be the present value of all the future cash flows it'll receive. 3, if you don't understand it, don't buy it. 4, in the short run, stock market's a voting machine. In the long run, it's a weighing machine. And the 5th and most important one, especially nowadays with all the news and the stories, a great story becomes a bad investment if you pay the wrong price. That is what principle-driven investing is. It's the reason I don't flinch when stocks fall. In fact, guys, I hate to say it, I get really excited when I see days like this. I feel like, oh, this is good. Things are getting closer to reality. I don't flinch when this happens because I'm not guessing. I'm not hoping. I have a framework, and that gives me confidence when others are freaking out. And to make it easy for you guys, I put together a free PDF that lays out all 5 of these principles, explains it completely, and it shows you why I use it and everyone in our Everything Money community used it. These 5 tenets are the exact roadmap I follow to stay calm, to stay focused, and build wealth over time. So click the link in the description, download the PDF, read it as often as you can, and apply the principles. When things get noisy, pull it back up and remind yourself we don't chase. We don't panic. We follow the numbers. We buy great companies at great prices. If they fall further, we buy more. That's how you protect your future. That's how you invest with confidence. And guys, before you think that I do this all the time. I have this in my office. I have this right here on my screen. I sit there and I want to understand these things at all time. I want it ingrained in my head because that's how I know I'll win. So where do we go from here? Guys, this market's stretched. It's built on hype. There's no denying that. And this never ends well if you ignore valuation and try to time the market. But that doesn't mean you should panic. It means you need to be smarter than the average bear, more disciplined, more patient. And guys, you and I all look around us and we see those average bears out there. We know we can be better than them, but it doesn't come over here. It's more over here. You have to have the tools up here, but if you don't have this stomach figured out, you're going to make the wrong decisions. It's about incorporating both the numbers and the emotion together. I want you to learn how to value businesses. I want to surround you with a community that keeps you grounded. This never ends well, but it doesn't have to end badly for you. So if you're serious about becoming a better investor, it all comes down to one skill: knowing how to value a business. Prices will always jump around. That's just the market doing what it does. But value is a lot more steady. It's way less volatile. And once you know how to calculate it, the noise doesn't shake you. I believe there's a moment coming when stocks are going to be incredibly cheaper. I believe there'll be a time when people flip the script on me. Instead of saying, Paul, you keep saying it's overpriced, it'll be, Paul, you keep saying it's undervalued. That will happen, but you'll be the one making smart moves saying, oh, glad I learned this early. So in the next video, I'm going to show you exactly how I personally value a company step by step. You're going to learn what to look for, what to avoid, how to protect yourself from overpaying for the hype. The link is right here on your screen, so click it and I will see you there. Thank you for your time.